Hello, welcome to the fourth quarter roundtable of Reagan Companies with Bowers & Company as well here in December 2020. You can't see us, but we're sitting around a table socially distanced, and we are all going to introduce ourselves here. I'm Bob Teska. I'm partner in charge of construction services at Bowers & Company.
Kevin Moteyunas, construction risk manager with the Reagan Companies.
Jim McElhannon, commercial risk manager with Reagan Companies. I'm also a partner.
And Fran Lowther, bond manager here at Reagan Companies.
All right, let's start. Take a look at today's topics. So the first bullet point is almost a little laughable. I'm going to give you an update as I know it currently at this second. Probably will be changed by the time you hear this. But the PPP, huge topic. Lots of interest in this. The way the CARES Act was written, the PPP loan was supposed to be forgiven and 100% not taxable. As soon as that was said, the Treasury came out and said, okay, when the loan's forgiven, it's not going to be taxable. However, relying on case law from years and years ago, the expenses won't be deductible, which is essentially saying the loan is going to be taxable. The amount of the loan that's forgiven is going to be taxable. There was some back and forth. Then probably about 2-3 weeks ago, the IRS came out with a very firm stance saying that even if you don't apply for forgiveness in 2020, but you expect the loan to be forgiven, it's going to be taxable in 2020. So there was no more. One of the tax strategies we were looking at is, well, let's not apply for forgiveness until 2021, and worst case, we defer the tax payments till 2021. That was put on hold, couldn't do that. As soon as the IRS did come out and say that, there was immediate response from Congress on both sides of the aisle saying, it's not right, this wasn't the intent of the law, we need to fix this. So there's been a lot of support for it. We are recording this on December 16th. There's been a lot of announcements I'm sure you've seen on TV and the radio where they've come together, and there's going to be another round of stimulus, potentially another PPP loan, some checks for lower income people to kind of keep the economy going and keep people on their feet. One of the provisions that looked like was in there was correcting the PPP so that it would not be taxable. It isn't passed as of today, so it's not for certain, but there's a lot of traction, and I expect that to happen. Again, if you filed your tax return today, it would be taxable. I do believe, based on everything I've seen, heard, people I've talked to, that that's going to be changed and it will not be taxable. Subject to change.
Boy, that would be wonderful. I think that everybody certainly thought that was the intent when they applied for it.
Yeah,
so
100%. Worst case, if it ends up being taxable, you still, even if you pay 30-35%, you still got 65 to 70 cents free for every dollar that you got. Not a bad deal, but it wasn't the intent of the law. I do expect that is going to change. So that's my long-winded, quick update on the PPP. So I think that puts Fran up.
Yeah, so I think that's real positive. Positive thing that's developed just this afternoon. And driving over here, listening to two of the different news organizations, they both seem to indicate what Bob was saying, that there was a general consensus, and that Congress would come to some conclusion, one positive conclusion on a stimulus bill. So those are all real positive things for everybody, as we all are eager to get 2020 behind us. The other thing that I see from an update, from a bonding perspective, talking to the people that I speak to on a regular basis, is this kind of a guarded optimism of 2021. There does seem to be some pockets of some work, some noise, background noise of architects who are busy, school districts that have work. So there is some guarded optimism on 2021. Of course, that being said, everybody understands that the sales tax revenue in the state and municipalities, everyone's broke. So that's a real concern, of course. And they're looking at that first quarter just cratering from a GDP standpoint. One thing that I look at that in my own humble analysis is the one thing that is not political in this world of everything politicized is that our infrastructure, the things that we need to fix and we need to build is apolitical. We need roads. Democrats and Republicans need roads. They need schools. We need those systems of ours to be safe. So I'm hopeful that, part of this new administration, that first 100-day of office will include some kind of an infrastructure bill. So I hope that's not me just being naive, but that's kind of a hopeful thought for 2021. So let's just all hope that that's what comes to fruition here in the next 30, 60, 90 days. In terms of the quick thought that we just wanted to get together today with this roundtable and just give some quick thoughts, some things to think about, that you can, from a proactive standpoint, from your business, from an accounting standpoint, the next few weeks are very busy. I guess 6 to 8 weeks, closing things out, and Bob is about to get very busy after January 1st. But sometimes from a business standpoint, our different businesses, we have a moment or a few moments where we can kind of take a breath and be proactive. So from an insurance standpoint, Jim and Kevin are going to talk about some of the things that you can do to be proactive and just tighten things up and maybe improve some systems. And from my perspective, we're going to talk a little bit about your stakeholders, the people in your business that we don't always think about, the bank, the bonding company, any lender that you use, equipment lenders, those type of people, and what you can do to get yourself in a position that 2021 is secure and comfortable from a financial perspective when it comes to those stakeholders. So what I'm kind of suggesting is to come together in some kind of a year-end planning meeting. I think initially the thought is sit down with your bond producer, and I'm talking from a perspective of from the bonding end of things, is to sit down with your bonding producer and have some conversations in terms of your operational objectives for 2021. Where are you going to be from a revenue standpoint, job size standpoint, a territorial standpoint? What are those things that are going to be critical that maybe the bonding company should be aware of? And then you want to come up with, in terms of your tax planning, where that's going to end up in terms of working capital and net worth, and how that relates to your third-party vendors, how it relates to your equipment, the people, your equipment lenders in your bonding company especially. Are those working capital and net worth, your debt structure, your debt to net worth ratio, all the things that you talk about with Bob and your CPAs, those important ratios, if they're in line with what those stakeholders are going to be comfortable with, so that you can make sure that you can attain your revenue goals and your backlog, your territorial aspirations, those kind of things. So really develop a consensus of the composition of that balance sheet ahead of time with your bond producer and with your CPA, and then schedule a meeting for your attorney, maybe. Include your attorney, your CPA, your bank, and your bond underwriter, and just kind of present to them your year-end successes, the failures, the lessons learned, all those things that made 2020 what it is and why it is, and discuss your tax planning strategies, your profit retention expectations, the distributions you have, bonuses, equipment purchases that are planned, anything that is going to impact that balance sheet, again, that is going to affect your creditor's ability to provide you credit. When you emerge from that meeting, with that consensus on net worth and working capital, you can be assured that there won't be any surprises. Well, there won't be any significance of surprises from a bonding standpoint or a banking standpoint. What happens in 2021 in the world, who the heck knows? But you'll be in a much more comfortable position knowing that all your stakeholders are on board with your planning process.
Fran, I think one of the key things that happens when you hold these kind of meetings is that you get to tell your story. It's kind of like writing your autobiography and then reading it, as opposed to just sending the financials or the year-end results to the stakeholders and let them interpret it. Big difference there between you interpreting it for them, painting the picture that they should see, as opposed to they might be have had a horrible day, looked at 6 sets of financials that were garbage, and they just start looking at them with that mindset. So I can't stress enough how important those meetings are, and the people that take the time to do them, incredibly beneficial.
Yeah, I think, that is our role. One of our roles is to be an advocate for our clients. So, and to be an advocate for our clients, we need to inform them of the rationale and the thought process of those people, the bank, how are they going to interpret this? Give our clients the information that they need to make the decisions that they need to make, and then counsel them. If you go in this direction, this is how it will be perceived. But you're absolutely right that, I want to be in charge of my own destiny. I don't want people making decisions for me, and I want to have a strong hand into how those decisions are made.
Yep. I think last question. I think maybe the last time we did this, we were talking about the surety market could go hard, being more difficult to get bonds. Have you seen that at all?
There are concerns from a surety perspective. The surety companies each year will come out and they'll discuss with us and explain, this is what we see. Now there's a big concern. The farther away from the prime contract a contractor gets, the more difficult it gets from a cash flows perspective, because the money's going to the GC, then it's going to the subcontractor, then it's going to the supplier. So that supply chain is a concern with all the other things associated with COVID, as of course a concern. I'm just, in terms of will there be a significant change in underwriting approach? I don't think so from a across the board perspective. There's just so much competition in this marketplace in New York State that, they're running a business as well. So I think as long as, there is an attention to working capital net worth, there has to be a consensus there. There has to be a understanding you need to buy in as a contractor into the basic surety 101 ratios and those perspectives. If you do that, then there is credit available.
Yeah, that's kind of been my experience. Obviously, somewhat limited work with the clients that I have. And it seems that the credit's still there as long as you have reasonable fundamentals in your balance sheet.
Yeah, and it's across the board. There's a lot of companies that are the standard, so to speak, mainstream surety companies, strong national, international companies, of course. And then there's also companies that are smaller that focus on emerging and distressed contractors. So there's across the board, there's plenty of capacity, as long as the basic financial principles are kept. As long as a contractor buys into the understanding of the significance and the importance of those ratios and the strong working capital net worth and those consistency from a reporting standpoint, there is capacity.
Nice. All right. I think insurance is up.
Yes, so kind of piggybacking off your question there, Bob, about the hard market, conversely to what Fran had just said, we are absolutely in a hard market, and it's hardened significantly since the last meeting that we had. And I think I'll take a few minutes and kind of update where we were to where we are, and then Kevin will talk about some different strategies and things that you can do during what's the typically slow time of the year to, maybe to bolster your situation. With this said, there's always space for best in class. So if you're best in class, these numbers may not really apply to you, but this is a general study across many spectrums of the market. We talked in our last meeting and said, that we were seeing different lines of coverage, general liability going up 7.5 on the low end to 10 to 15% on the high end. And without going back through all those numbers, where we are today is our estimates that were the high end is now the low end. And we're, auto and property, for example, are going up double digits across the board. Umbrellas are up on average 22.9%.
I've actually heard that a lot from clients. What's driving the umbrella piece? I don't understand that.
What's driving the umbrella piece is the catastrophic losses is really what it boils down to. There's the large natural disasters is certainly having a big impact on that, but it's really these what we call nuclear verdicts. So, and this is across all spectrums of the industry, not just construction. And they're up over 300%. And so it's a huge impact. But you couple that with COVID, the losses are higher than they were expected to be. Social inflation, the median value of the U.S. dollar, verdicts being up over 300% since 2014, hence the nuclear wars that I was referring to. The catastrophic losses, it's been an extremely, extremely active year. Whether it's the natural disasters in as far as hurricanes or the fires in California, tsunamis in Asia. It's been a very, very active year. Lower interest rates. Insurers make money through premiums, but also through investments. That's driving that. And then reinsurance, the reinsurance reluctance there. The insurance for insurance companies is becoming more expensive, right? So what does the insurance carrier have to do? They either pay more for their insurance and pass that down to the policyholder, or they take on more exposure, which they're going to price into our premiums as well. So the trickle down is that we're seeing significant impacts, and this has been going on over a 3-year period. Just in the last 7 months, it's really, really ramped up quickly. In certain segments of certain industries are certainly being targeted much, much harder. Certainly, if you have loss activity and you couple that with all these things, you're on the much, much higher end of that spectrum. And it's a pattern that I don't see changing anytime real soon. So if you haven't already renewed and you're going into 2021 and you're bidding projects, keep that in the back of your mind, because your renewal will probably look different than your current program. So it is something that you need to plan for accordingly, because you need to have that additional cost built into your project, so you're not being surprised. There's different things you can do. You certainly want to review your insurance program, bolster all your risk management efforts, know your losses, know what your history looks like, right? I can't tell you how many times we sit down and meet with somebody and they it's a first meeting and they tell you they don't have any losses. Oh, wow, this is great. This should be an easy fix for you. You're certainly out of line with where we think the ratios should fall for you. And then you get in there and there's all kinds of activity that they just forgot about, or, I'm not sure exactly what happens there, but, the advice would be budget wisely and plan ahead. Consider alternate insurance programs. Captive insurance programs are very, very cost effective for the right client. It's certainly a nice avenue. But the fact that remains is there's nothing you can do about these global trends. What we really like to focus on are the things that you can do to control your pricing. And Kevin's going to talk a little bit about some things there. But, it's really taking a deep dive into you organizationally and control what you can control, right? There's a lot of different strategies, but it takes pre-planning. And again, I really want to emphasize the fact that if you have not already renewed, you really need to be thinking about these things, because those costs could really send a job from being a profitable job and turn it into a loser very, very quickly without you even being prepared for it. So, use this traditionally slow time in the construction industry. Most of our guys, are seasonal. This is a great time to take a look at a lot of these things and use that time wisely. And Kevin's going to talk about some of the things that you can do during this time.
Yeah, thanks, Jim. 2020 has been an absolute crazy year, and I think everybody knows that. And with that, you hear Jim talking about the change in the insurance market. Regulations have changed quite a bit in 2020 as well. So as far as your corporate policies are concerned, if these aren't policies that have been reviewed in the last 12 months, we highly encourage you to have each one of those reviewed and updated. We do have an administration change coming up that we anticipate. We don't know exactly what that's going to hold, but as we sit here right now with all the changes taking place in the last 12 months, it's prudent to have those policies looked at, updated, so that we can say, as of this day that you get that back, we know that we're compliant in all these areas. Also, take advantage of the downtime to conduct any of the required trainings for 2021. One example is the sexual harassment training here in New York. This is an annual training that you've got to do with all your employees, and there's several ways to do it. We've got, at Reagan, we've got a portal called Think HR. It's a pretty slick online tool where you can have everybody go in, conduct this training. It generates a certificate, timestamps when they did it, automatically goes into their file. So there's a lot of other values and training included in that Think HR portal, but this is just one example of many. Also, another date to remember is your Osha filings. Make sure you've reviewed those for accuracy, making sure that we didn't over-report or under-report, and we've got to have those posted by February 1st. And then make sure you prepare for the March 2nd requirement of OSHA's electronic record-keeping submission. This is something they started to require about 2 or 3 years ago for employers that have 20 or more employees. For anybody who's tried to go on to OSHA's website and do it through OSHA.gov, it's an incredibly cumbersome process. The government doesn't like to make things streamlined and smooth with the websites they use. So Reagan Companies has gone out and partnered with a company called OSHAlogs.com that we offer to all our customers free of charge. And it takes that entire process of electronic reporting and streamlines it, makes it very, very simple from a data entry standpoint. But more importantly, over-reporting or under-reporting OSHA recordables is a very common error that we see because there is so much ambiguity between what is recordable, what isn't. This software is smart enough to identify as you're putting in these incidents whether it's recordable or not. So it substantially improves the accuracy of what you're reporting, which is very, very important to the picture that's painted to the outside world as, you know, how safe your company operates. So, you know, the bottom line is we are here to help you navigate this stuff. It's not easy. Everybody's facing the same challenges. If you have questions with any of this stuff, and we're just this is the tip of the iceberg with what's required as far as compliance is concerned. But give us a call. We're here to help. We've got the tools and resources to provide to you, and yeah, we're here to help you navigate these waters.
Awesome. Hey, Jim, let's just back up 1 second. You mentioned captives might be a way to save. I know they're complex, but give me a quick overview of who's the right client for a captive.
Right. That's a great question, Bob. So really we kind of look at checking 3 boxes. Are you financially secure? Do you have a strong commitment to safety? And are you entrepreneurial? If you have those 3 things, which if you're a contractor, I know you're the last, the third for sure, right? There's not a contractor out there that's not entrepreneurial. But if you check those 3 boxes, then it's something that you should actually kick the tires on. The next threshold will be is how much you pay, right? You've got to be, you know, the ideal client is $250,000 between your general liability, your workers' compensation, and your auto. If you total those 3 policies up and you're paying $250,000 or more, it's something that makes sense to take a look at. If you fall below that threshold, sometimes the risk reward isn't necessarily there. So that's not a hard line, but it's necessarily, it's kind of the benchmark for where it really starts to make sense. But honestly, if you think you're better than the rest of the people in your industry from a program standpoint, you're not having those type of losses. Your experience mod is kind of a first indicator, right? So if you're below 1 in your experience mod, if the insurance company is winning on your account year over year over year, then you're the right person with all those other variables that I had mentioned. And it is something that we specialize in. I believe we're probably, if not the largest, one of the largest captive agencies in Central New York.
Awesome. All right. I think that's going to wrap it up. Like I said, our contact info is on that second slide. If you have any questions about what was covered, except for the PPP loan, because I'm sure that's changed by now. But any questions at all? Oh,
I got one other one.
Okay.
We're getting closer to Super Bowl.
Yeah.
We all made predictions.
Yes.
Is everybody still alive?
Start with Bob.
I'm going to have to stick with my dad. I'm going to go with the Patriots, even though Brady left.
Did you change that up from the last?
I did.
You did, yeah.
I did. He kind of yelled at me.
He heard it and all.
He took me out to the woodshed.
We've all been there.
Well, I am going to stick with my my prediction from our last webinar, and that is the Buffalo Bills, and I got a lot of flack for that, but as I sit here right now, I feel pretty good about it. They're doing all right.
I'm going to stick with my Raiders. They're still mathematically alive. I know it's a long shot, but I'll stay true to my silver and black.
And I think I went with Chiefs.
You went with the conservative.
I'm the conservative bond guy. Yeah, Patrick Mahomes. That's all I got to say.
That's a lot right there.
All right. Do not place any bets based on that information. All right. Any questions, let us know. And with that, we're all set. Thank you.
Bob.
Thanks, Bob.
Thank you.